All right, welcome everybody. Hope you're all doing well. Thank you for joining today with this MyFed University webinar on the 2026 tax changes and the tax mistakes made in retirement. This is a topic that we get a lot of requests for. Obviously, if you ever attended a MyFed University webinar in the past, you know we go pretty deep into a lot of different topics, and tax planning is always one of the ones that are at the top. And there's a lot of changes coming for 2026, and so we've had some questions on this. We have a couple thousand people on right now, so I want to make sure that we just get the information out to allow you to be able to make your wise choices this year in 2026 when it comes to the opportunities you have in front of you and the tax changes that were presented to be able to take advantage of in a positive way. Again, my name is Ryan Polimeni. I do a lot of these MyFed University webinars along with a lot of my other colleagues that help out with the MyFed University webinars and topics. And I've had the privilege of teaching these workshops now for over a decade. We just got back 2 days ago from doing a workshop just like this at the Pentagon, so really exciting. Love to be able to give this information, but this stuff is going to be really important for a lot of you that are within a few years of retirement, or even if you're young and you're trying to figure out how do I best put myself in a position to take advantage of all the taxes that are available to me to keep them lower later in retirement and take advantage of them today while I'm working. And so these are going to be really the top 10 tax mistakes that we see. I want to give a couple disclosures. As a network representative of MyFed University, I conduct these workshops all over the country. Today is going to be general information. Obviously, you're going to hear me talk a lot about taxes, a little bit about estate planning. Do not take this advice. Just go out and do what you got to do without getting advice from a professional. So I will say that. Make sure that you take this as general information. You will have the opportunity to get every single one of your questions answered. That I will say. I won't be able to take any questions while we're live, obviously for the sake of time. But at the very end of the workshop, you'll have an opportunity to write down all of your questions, and somebody from MyFed University will give you a call and just answer your questions for you, so you have that opportunity at the end. So I always recommend take as many notes as possible. When we do these workshops, we typically get people write us a book on all the questions that they have, and actually it helps a lot so that we know how to help you with your specific questions. Okay. Now, over the course, we're going to talk about a few different things. Obviously, we're going to talk about IRA distribution and taxes. A big question we get is, hey, if I'm getting ready to retire, I want to start taking my money, how does that affect my tax bracket? We hear about these things called Roth conversions and Roth IRAs and Roth TSPs, and what does it all mean, and how do you actually make those decisions on when to go Roth versus state traditional? And we're going to talk a lot about the differences between those two today, because a lot of common mistakes that I've seen. I've had the privilege of doing this now for 16 years, and I can tell you I see a lot of common mistakes made when it comes to Roth and conversions, things of that nature. Social Security, for most of you, it's either going to be your first largest fixed income or your second largest fixed income. And by having Social Security, understanding how Social Security is taxed plays a really big role in how you think about your distributions and how you think about when to take it. So we're going to take a deep dive into that. This one right here, the required minimum distribution, or you may hear it referred to as an RMD. Let me tell you, this right there is probably the biggest silent killer of people's retirement. I'm going to give you some examples as we go of all these different things today. But that one right there is the one thing that really affects most people, and it's never talked about, or very little talked about, I should say, because reality is it's overlooked. Because for a lot of you, if you're in your early 60s, it doesn't affect you for 10, 15 years, but it's got to be made part of your overall financial planning decisions, because it really does have an impact on your retirement. And I will go over that in detail as we go. Taxes on pension, understanding, hey, almost most of you, I would imagine all of you, as long as you meet the right criteria, are going to get a pension, or you're referred to as an annuitant, from the government, and there will be taxes on there. So we'll talk about how those look. And lastly, understanding taxes with the new estate planning rules and how that affects your family, both if you're married or if you're passing money on to your kids. Those play a really big role, and every year these things keep changing, and I see a lot more mistakes being made, because look, I understand a lot of these tax decisions, they're hard to keep up with, right? I mean, every single year, unless you're following the IRS tax code, which not everybody does that. But if you don't, there's mistakes that can be made. We're a registered tax and wealth management firm. We've been teaching this stuff and working with people all over the country for a long time, and these are the mistakes that we see is really built around these taxes. And so here's the thing: is tax planning can be difficult, and obviously we're talking a lot about taxes because this is a tax webinar. But the reality is the foundation, and I would probably write this down because this is a key point to this, is the foundation of every financial plan falls on taxes. Every decision you make, whether it's wealth management, estate planning, tax planning, distribution, income planning, social security planning, it's all built on the foundation of taxes. And here's one of the biggest mistakes that we see after doing this for a long time is you may have someone that does your taxes. Maybe you do them yourself with TurboTax. Maybe you have a CPA. Maybe you have an accountant or just somebody like H&R Block, whoever. It doesn't matter. You have somebody that's helping you with your taxes. And maybe you've got an estate planning attorney you're working with that's doing your wills and trust and powers of attorneys and advance directives and all that's helping you with your family. Then maybe somewhere in the middle, you have somebody that's helping you with your wealth management or your insurance planning, your Medicare planning. And those are all great people to have on your team. But here's the problem that I've seen and that we see a lot as we work with federal employees around the country is there always seems to be this disconnect where the tax person's not in communication with the estate manager or the estate planner is not in contact with the wealth management team who's no longer in contact with the tax person. And all of a sudden you have these disconnects and you will start seeing some flaws in your retirement plan. And again, I don't share that to make anybody nervous, but to think about, if we don't have all of these pieces connected, where are the mistakes going to be made? Because if I'm building wealth, but I'm not doing it on the foundation of taxes and making decisions based on how my taxes are going to be affected, both short-term and long-term, that's going to be a problem. If I'm not talking about, Roth conversion so that I can make sure that when I die, my estate gets is little amount of tax as humanly possible, right? Because we're passing money on Roth instead of traditional. See, these are the pieces that all have to work in harmony with each other, and that plays a really big role in the success of your retirement. Okay. So these are the new 2026 marginal tax brackets, and pay attention to these for a second because they changed, and every year they continue to keep changing. Now, luckily, and I know it doesn't feel like this, right? But luckily, we are in the greatest tax environment that we've actually ever been in. And I know it doesn't feel like that because some of us are going, man, I don't know how I can keep paying more in taxes than I do. But the reality is this: we have more space between our marginal tax brackets than we've ever had before, with some of the lowest ordinary income brackets that we've ever had, 10, 12, 22, 24, 32, 35, 37. There's a lot of room between each one of those brackets. And let me tell you what that means for you to be able to take advantage of is when you are doing high-level tax planning, the more space you have between each bracket, the more planning you can do. Here's an example. We're going to talk a lot about things like Roth conversion because you as a federal employee have that opportunity for the first time this year in TSP. And if you're going to make those decisions, the more room you have between each bracket allow you to convert more. That's just one simple example. But here's what I want you to pay attention to. These are called marginal tax brackets. And of course, most of you listening are going to be within the 22 to 24% tax bracket. That's normal. Now, being that these are called marginal tax brackets, this is the highest bracket that you're going to fall into. It does not mean that if you were in the 22% tax bracket, all of your money is taxed at 22. You're going to have some in the 10, some in the 12, some in the 22. And what's important to understand about that is that what you actually pay tax on is called your effective tax rate. And I would write that one down because your effective tax rate is the percentage that they kind of all average out to pay on. So for example, if you're in a 22% tax bracket on the very low end of it, you may actually be paying 15 to 18% in federal taxes, not 22 on everything. But that's an important number to pay attention to when you're doing tax planning. I'll give you some examples as we go. So just quickly take a look at these brackets, find out where you fall. Maybe if you're married, obviously in the middle, that's married filing jointly. If you're single, that's on the left over there. So find the bracket that you're in, and then you can figure out what tax bracket you're going to fall in for the year and what room do you have. Now, identifying your tax buckets, these are important because when you do this and you're identifying different tax buckets and where you're going to fall, there are really a few different buckets here. Number one, you have a 1099 now, right? That could be something that's taxable today. It doesn't have to be 1099, that could be W-2, right? So that is a 1099 now, which is a money you're paying tax on today. So you're receiving your paycheck, right? You're paying your tax on every paycheck that you have, okay? Then you have this bucket of money called tax deferred. And what does that mean? That means that's your traditional TSP. That's the money you're putting in before you pay tax on it. So what are you doing? You are deferring your tax liabilities to a later date, right? So, hey, I get my paycheck before I pay taxes, and money goes to TSP, and I haven't paid tax on that money yet. But when I take that distribution, I put that in my pocket, that is when I'm taxed. I'm deferring my taxes to a later date. Then we have a tax advantage bucket, right? That's like your Roth TSP. That is where, hey, I'm going to take advantage of the taxes today, being at the lowest that we could really possibly be in at the moment. I'm going to take advantage of those taxes today. I'm going to get my paycheck, going to pay the tax on it now, and later, when I begin to take my distributions, all of that money is potentially going to be tax-free, okay? So that's a very different bucket. And lastly, this bucket for Social Security is really important because Social Security is taxed based on how much income you earn. I'm going to talk about that shortly. But I really think it's important that as you begin this planning process, whether you're retiring within the next couple of years, whether you've got 10 more years, 15 years, it does not matter. Focus on where your money is going and the tax buckets that they're falling into, and figure out ways that you can begin to be more tax efficient as you excel in your career. So, because the big question is going to be, what income are you going to need from these buckets, and how are they going to be sent to you? Are they going to be tax deferred? Are they going to be tax free? So these are important decisions as you begin to put money away. Okay. Now we want you to become smart with your withdrawal strategy, right? Because again, let me ask you this question, which is going to be an obvious answer, but would you rather take a distribution and the entire thing be fully taxed, or would you rather take a distribution and the entire distribution be tax-free, right? It's an obvious answer, but that should start to begin how you shift your thinking about being more tax efficient while you're working and then into retirement years. And again, these are all fall into where people make mistakes. So one of the other changes that's important, now this is kind of just still building the foundation of what happened in 2026. So we have this thing called a standard deduction, right? The standard deduction is kind of that gift the IRS gives us because most people don't itemize enough to surpass this, but these are big. So as a single filer this year, the standard deduction, meaning what you can basically withhold from your taxes, or what's going to bring your tax liabilities down, for a single filer is $16,100. Okay. For a married couple filing jointly, it's $32,200. That's a big number for married couples to be able to basically lower their tax liabilities by $32,200. If you're head of household, it's up to $24,150. And if you're married but you file separately, that's $16,100. That's the same as a single filer. Okay, so these are important because when you're thinking about tax planning and do I go Roth, do I go traditional, I'm going to show you how these standard deductions play a really big role in your ability to make the Roth versus traditional decision. Okay, now here's something else that changed. The IRA and TSP contributions went up. So you have an ability to be able to put more away. So for example, the regular contribution for 2026 is $24,500. So it doesn't matter what age you are. Any age you can put in $24,500 into your TSP. Now you also get the catch up. In order to get the catch up, you have to be over the age of 50. But you can either put in $8,000 if you're over the age of 50, or if you are between age 60 and 63, you could put $11,250 as your catch-up for the year. A lot of people don't know that. That's important. Okay, so you have the ability to put in 32,500, or if you're in that 60 to 63 range, you could actually do up to 35,750 for the year. So that's important. That's a big number. Now, IRAs, now this is on the outside of TSP. You could do 7,500, and you could do a catch-up of 1,100. Now, there are income limits for Roth IRAs. So for those of you that have Roth IRAs on the outside, there are income limits. And I'm going to kind of give you the really important part about TSP, though. But for those of you that are contributing to a Roth IRA in the private world, as a single filer, your phase out begins at 153,000. That means that you cannot put the entire 7,500 in with no catch-ups. You're making too much money. Now, once you hit 168,000, you can't even contribute to a Roth IRA anymore. Now, if you're married filing jointly, the phase-out period for how much you can make before you're going to start having your contributions limited is $242,000. And once you and your spouse exceed 252,000, you can no longer contribute to a Roth IRA. But here's the power of using TSP to your advantage. TSP does not have an income limit on his Roth TSP. Let me repeat that again. These phase-out periods do not exist inside TSP for the Roth TSP contributions. That is massive. That means that you can make $400,000 a year working for the government, and if you're between 60 and 63, you can put $35,750 into that Roth TSP. That's a huge opportunity for a lot of you to be able to really take advantage of this. And remember, even on the outside Roth IRA, you're still limited to how much you can put in. You can put in 3-4 times the amount inside TSP than you could on the Roth IRA. So we get this question a lot: should I contribute to a Roth IRA? It's completely up to you. But before you start contributing to the outside, let's max out the inside so you can really take advantage of what's given to you there. Okay. Now, I want to give a word of caution for the catch-up. This is important. Is with the catch-up contributions, I told you have that ability to be able to put more in over the regular amount, but make sure that any catch-up contribution that you do it on a 26 pay period basis. We were just teaching a workshop at one of the VA hospitals in Virginia. Had a doctor come up to me. This was late last year in September. Doctor came up to me after I was finished giving the workshop, and he said to me, "Ryan, I'm not getting my matching contribution anymore." And when we sat down, we looked over his finances, we figured out that the reason that he's not getting matching contributions is because he had already maxed out his contributions for the year by September, because he didn't do it on a 26 pay period basis. Therefore, he kind of got caught in this position where they're not matching anymore. Okay. And here's another thing that's really important to pay attention to. A lot of this is going to affect a lot of you on here, is new in 2026. If you earn more than $150,000 last year in 2025, your catch-up contributions must be to the Roth TSP. Okay, and you go, "But Ryan, I didn't have a Roth TSP opened." You do now. Okay, and that's where that's going. So important on there. Now let's talk about these top 10 mistakes, and I'm going to kind of go through them piece by piece, and I'm going to give you some examples as we go so you understand what to pay attention to and how to not make these mistakes. So number one is understanding your taxes on distributions. Those traditional TSPs that you have, the traditional IRAs, maybe you work for another private sector job before you came to the government. You have an old 401k, 403b, 457, whatever. Any time that you see traditional, pre-taxed or tax deferred, make sure you are clear that every single penny that you take out of that distribution bucket is fully taxable at ordinary income tax, depending on the state you live in, both federal and state. Now, always federal, but state tax depends. So that's really important. Is a lot of people say, well, if I start taking distributions from my TSP, do I get a certain amount of distributions before I have to pay tax on that? Not in the traditional world. If you have traditional TSPs, every single penny that's going to come out of there is fully taxable at ordinary income tax. Okay. Number two, not taking distributions evenly. This is so important when you are really planning for taxes, because here's what happens. There will be years where you retire, and let's just say you have $500,000 in your TSP. You did a great job saving. You got $500,000 in there. And one year, you take out 20 grand. The next year, well, you got to go buy a car, so you take out 50. Then the following year after that, you only take out 10. But then the year after that, you take out 60, right? By doing it that way, what you could potentially be doing to yourself is going from one tax bracket down to the bottom to the next one, back up to another high tax bracket, back down, and all of a sudden your tax bracket looks like a heart monitor, right? It's going up and down, up and down, up and down. But this is so important to pay attention to, because for those of you that want to do good tax planning, the way that you can take distributions evenly, maybe just create a fixed income from your TSP, whether it's just calling up and saying, hey, send me some money regularly, but at least you know what your fixed incomes are. One of the most important things is to have all your fixed incomes in that bucket well taken care of, so that if in the event that you do need a new car, you want to go on a vacation, you want to help your kids or your grandkids, and you start drawing more money from TSP, you will have an idea what your limits are going to be before you go to the next tax bracket. So distributions evenly are really important. And we get a lot of questions on this, but that's a really important one there. Now, number three is something that I have seen affect a lot of people. Whether you are rolling over a existing 401k into your TSP, okay, or you are rolling your TSP to an outside IRA of your choice. And again, whatever decision you make, understand that one of the big issues and mistakes that we see a lot is people rolling over their IRAs into TSP or out of TSP incorrectly. And if you do roll it over and it goes into your pocket instead of to where it's supposed to go, that can create a fully taxable event for yourself. We had somebody that came in our office. She was trying to roll money actually into her TSP because she was young, had an old 401k. And because every company has their own way of being able to send money, to transferring money, she didn't understand the rules of that company. And they sent her a check. She stuck it in her bank account and said, I'll make sure that I write the check. Well, guess what? If you don't do that within 60 days, that entire process becomes a fully taxable event. And unfortunately, she didn't know that there was a 60-day grace period. She came into our office. There's nothing that she could do. She was past that point, and that became a huge taxable event for her that year. So again, pay attention to the way that you're rolling money in or out, because every company has their own transfer process. We see a lot of mistakes made here. And of course, listen, a lot of these things are going to spark some questions for you. And like I said at the very beginning, at the end of this workshop, you're going to have the ability to ask any questions that you want, and we will answer them for you. Okay, I can't do it live, but write us a book. As I go through here, if there are specific things that you want answers to, or maybe questions that you want to get answers to, go ahead and fill out that form at the end, and we'll make sure we get to you. Okay. Now, here's Roth IRAs or Roth TSPs and how to take advantage of it. I think Roth is one of the greatest gifts that the IRS has given to us, to be honest with you. I don't think people use them enough, or they don't use them properly. But let me tell you, this is something that everybody should try to take advantage of. I'm not saying that you can. It depends on your situation. But a lot of times when people come into our office and they're asking us, hey, Ryan, should I go Roth? Should I go traditional? Can I do both? What should I be doing? The first thing that we do is we take everybody through this exercise and we work backwards on the numbers. So let me give you an example. This is an example of a federal employee that came in our office, and he makes $70,000 a year in his gross salary. Now, he's a single filer, okay? So obviously, like we talked about earlier, that standard deduction comes right off the top. So we start at 70 grand with what his salary was from the government. IRS 16,100, we get that 53,900 of taxable income that you can see on your screen. Now look, because he's a single filer, look at the tax brackets to the right of that 22, right? He's still in a 22% tax bracket. Why? Because the 22% tax bracket goes from 50,401 up to 105,700. So therefore, even with standard deduction, it still did not bring him down to a 12% tax bracket. So he contributes $10,000 a year to his traditional TSP. And remember what I told you, those traditional TSP contributions lower your tax liabilities as well. So here's an example of how traditional TSP really is working in the favor of this individual, because now after that $10,000 TSP contribution, the total taxable income is 43,900. Now what does his tax bracket look like? Well, let's look at the 12% tax bracket right there on your screen. You have 12,401 up to 50,400. So being that he's at 43,000, he is now into the 12% tax bracket. So he started at 22, but the IRS standard deduction and his traditional TSP contributions allowed him to go down into the 12% tax bracket. But this federal employee is going to be able to get the best of both worlds, because if you look at that 12% tax bracket again, he has all the way up to 50,400 before he goes back into the 22. So this is a situation where, because he's total taxable income is 43,900 and he's got up to 50,400, he could do a combination of traditional and Roth and still stay in a 12% tax bracket. This is how you get the best of both worlds. Now, for a lot of you, you've got to work the numbers backwards. And if this is something you'd like help with, just let us know. Just put down, run my Roth numbers. We'll know exactly how to do this, because this is important. There are a lot of you that are in this position right here, and you are not taking advantage of the best of both worlds. And I want you to. I want you to get everything you're entitled to. This is one of those things that's really important for you to know how to do and how to take advantage of. Okay. Now, this is a big one. In January 28th of this year, you all got an email. Every single federal employee who is participating in TSP received an email that says you can now do Roth conversions inside your TSP. And let me tell you what, if you can take advantage of it, it could be a great thing, but it does come with some fine print. So before we dive deep into this, let me tell you what a Roth conversion is. A Roth conversion is when you take traditional money, that pre-tax money that we talked about, and you convert it over to a Roth TSP or a Roth IRA. It doesn't matter. Roth conversion just is when you move money from a traditional account to a Roth account. And yes, when you make that transaction, that is a fully taxable event. So let me give you an example of what I mean. Let's say that you say, hey, I'm going to convert $100,000 of my TSP, and you're supposed to withhold 22%, right? That $22,000 has got to go to the IRS. So you convert 100 grand, but the reality is about $78,000 of that money should be going into that Roth. The rest of the money is getting sent to the IRS. That's what happens when a Roth conversion happens. However, that $100,000 is a fully taxable event. So you have to understand what we talked about earlier. What are your limits to being able to convert and stay in the same tax bracket? Now, in the private world, let's take TSP out of the equation for a moment. When you do a Roth conversion in the private world, if you go from a traditional IRA to a Roth IRA, and my example, we move $100,000, right? That $22,000 in my example for taxes is going straight to the IRS, and 78 grand is going into your Roth. Okay, clean, done. We're moving on, right? We took care of our tax liabilities for the year. However, with the TSP Roth conversions, there is one major difference that's got to be paid attention to, and this is where I have already seen an incredible amount of mistakes that are unreversible that are happening, okay? In your TSP, you can now open up that Roth TSP and convert whatever money you want to from the traditional to the Roth TSP. However, unlike my previous example of the money, the tax money being withheld and sent to the IRS, you are 100% responsible for paying the tax on any Roth conversion you do inside TSP. You do not have the ability to withhold taxes on that transaction. So if you say, hey, this is the greatest thing since sliced bread, let's move that 100 grand right now, let's do it, and you did it, you notice that 100 grand went from your traditional to your Roth, but you now owe the IRS $22,000 in this example. Could be more, could be less. So unless you have tens of thousands of dollars lying around in cash that you don't mind paying taxes on, or paying taxes with, then maybe this is one of those things where you got to figure out, does it make sense to do it with TSP or in the private sector? And that, obviously that would require you moving out of TSP if that fits your overall plan. I don't know what your plan is, but whatever is the best thing for you and your family, that's what you do. But I need you to understand what the options are on there, okay? Now, you can do up to 26 conversions a year. Basically, you can convert every pay period if you want. You cannot combine any personal Roth accounts with a Roth TSP account, okay? So that cannot happen. If you have an old Roth 401k, you can combine with a Roth TSP. So it has to be retirement account to retirement account, but you cannot commingle personal accounts with Roth TSPs. Now, I know there's a lot to that. And that Roth conversion, let me tell you, there is a lot that goes into there, because when you're doing Roth conversions and you're building out a tax strategy, we did well over 100 of these last year at our firm, and I'm telling you, there's a lot that goes into it. Number one, you have to know your limitations on how much you can convert before you go to the next tax bracket. And if you go to the next tax bracket, you got to pay attention to that internal tax amount that I was telling you about earlier. That could go up. That effective tax rate could be drastically affected by that. Okay. Number two, if you are in the age of where you have to worry about Medicare and your IRMA, there are limitations to how much income you can earn before your Medicare premiums go up. And remember, anytime you do a conversion, that is a fully taxable income. So there are a lot of moving parts to pay attention to. So once again, if Roth conversions is of interest to you, write that down in the form at the end, and so we understand that's something you want to explore and talk about, so we can at least give you the examples of what that looks like for you. Okay, and this is a big one also. So number 6, top 10 tax mistakes. Number 6 is taxes on Social Security. Social Security is either 0% tax, it is up to 50% tax on your Social Security, or 85% of your Social Security could be a taxable income. And how does that break down? Well, here's how it looks. There's a formula that the IRS has called the provisional income formula. And what they look at is how much money, what are your taxable incomes plus half of your Social Security benefits. So here's an example. If you are a single filer and you, after all your incomes combined, your FERS annuity or your CSRS annuity and your distributions from TSP and half of your Social Security, if we add all those things up and that equals less than $25,000, there's no tax on your Social Security. Okay? If you make between $25,000 and $34,000, up to 50% of your Social Security benefits will be a taxable income. Now, taking that one step further, if you make more than $34,000, up to 85% of your Social Security could be a taxable income. So let me give you an example of what that means. Let's say that you're a single filer and your Social Security benefits are $2,000 a month, right? So easy math says that 2 times 12, that's $24,000 a year. So what if you fall into the category where all your incomes put you beyond that 34,000, which by the way, spoiler alert, most of you federal employees are going to be in the situation where you're going to fall into that category because you have multiple fixed incomes. Okay, so but what does that mean? If my Social Security for the year is $24,000 and I fall into the category where up to 85% of my Social Security is taxable income, that means that out of that 24,000, 20,400 of that Social Security is going to go on your tax return the following year as a taxable income. So I hope that you have withheld taxes on your Social Security, because if you do not, and you have 20,400 in my example hitting your tax return the following year, and you owe $5,000 on that, that is a tax bill I don't think that you want going into your first or second year of retirement, right? Those are things that hurt, and those are mistakes that I see made all the time. And listen, whether you're doing this by yourself or if you're working with an advisor and Social Security maximization and the tax on this is not being talked about, that is a red flag, because it is so important to make sure you add this into your overall tax planning strategy, right? Because I go back to, if you're going to do things like Roth conversions or you're doing tax planning and you don't add this $20,000 to your taxable income, you just messed up the whole deal, right? It is so important to have this as part of your overall strategy. Now, for those of you that are married filing jointly, they give you a little bit more leniency here, right? They give you a little, because this is both of your incomes combined, that is going to allow you to figure out what your tax is going to be. So let me give you an example. If you and your spouse combined income after that formula is less than 32,000, there is no tax for either one of you. However, if both of your incomes combined are between 32,000 and 44,000, well, up to 50% of your Social Security will be hit your tax return as taxable income. Now, if the two of you combined make more than 44,000, which is pretty normal to be honest with you, up to 85% of both of your Social Securities will now be a taxable income on your tax return. So let's go back and say both of you, your Social Securities are $2,000 a month, right? That 24 grand a year we were talking about. Well, guess what? For one of you, 20,400 of it was going to hit your tax return. Now you got to times that by 2, and man, now we're over $40,000 potentially for taxable income for Social Security for the two of you. You're talking about a $10,000 tax bill potentially here, or at least an $8,000 one. So the point being is, as you approach Social Security, please make sure that you're withholding taxes, because this is a silent killer of a lot of people's retirement. I see a lot of people make mistakes with not understanding how it works and not withholding, and they get a big old tax bill, and I don't want that for you. I don't think you want that either, right? So here's mistake number 7. I had mentioned this earlier, but this is something that I want to spend some time on. This is the silent killer of most people's retirement, because they don't even know it's coming. So when you turn either 73 or 75, depending on the year you were born, so if you were born before 1960, your required minimum distribution age is 73. However, if you were born after 1960, your new required minimum distribution age is 75. So here's what happens. When you turn either 73 or 75, depending on your age, the IRS is going to knock on your door, and they are going to add up all of your traditional accounts. So that could be your traditional TSP, that could be your old 401k that's traditional that you forgot about, right? Or maybe it's just sitting there, you haven't moved it. Anything that is traditional, your traditional 403bs, deferred compensations, 457, defined benefits, profit sharing, anything that is a traditional IRA or TSP is going to be subject to the required minimum distribution. And what happens is the IRS is going to add up all of those accounts, and they are going to tell you how much you have to take from them. So let's give an example here. Let's say that we are 73, and here's a real example of how RMDs work. And by the way, we will run an RMD report for you. It's just something that everybody gets because we get so many requests for it. So we just make it part of what we give to you. But this would be something that I would write down, is get my RMD report, because you want to know your numbers. So here's an example. This is an example of a 73-year-old that has $500,000 in their traditional assets. This is actually something from TSP. So the day that they turn 73, the IRS is going to start forcing them to take $19,531.25. But here's my question to you. What if you only needed $10,000 a year? What if your pension from the government and your Social Security is enough to cover most of your expenses, but maybe you take out $10,000 or $12,000 a year? Guess what? Too bad. The IRS is going to say, I understand you're taking out 10, you're taking out half of what you need. We are still going to force you to take out the additional $9,531. You go, but I don't need that money. The IRS says, too bad. You are forced to take out. And let me tell you what happens. For a lot of people, the extra amount that they need to take out because they are forced to take it out is one of the biggest pieces to the financial puzzle that pushes people to the next tax bracket. I see more people in retirement go from a 12 to a 22% tax bracket because they did not plan for the required minimum distribution. And that additional 10, 12, 20, $30,000 a year, whatever it is, that they force you to take out that you do not need, is the thing that pushes them to the next tax bracket. And guess what? When you're 73 and 75, not a lot you can do about it anymore. So how do you avoid something like this? Or how do you be proactive versus reactive? Number one, start participating in Roth while you're working. Roth TSP, Roth IRAs are not subject to RMDs. Very important. Number two, do Roth conversions, because again, Roth IRAs are not subject to RMDs. So let's say you're 60 or 63 or 65 and you're retiring. That would be a great time to begin doing Roth conversions, because maybe you get yourself in a position where you don't have an RMD at all because you converted everything, or maybe you didn't convert everything, but the amount of money that you're taking out, that $10,000, that's all you need. Well, maybe your required minimum distribution is only $10,000 and you're good. You're taking it out anyway, so no big deal. But this is being proactive versus reactive in the future. And this is so important to pay attention to. This is why at our firm, we're a tax firm and a wealth management firm. We do well over 100 of these every single year with those Roth conversions, because the goal is to minimize how much the RMD could affect you. Because what are some tax issues that this could cause? Well, number one, like I said, it could push you into a higher tax bracket. Number two, remember I just told you about how Social Security is taxable? Because you have your total incomes and half your Social Security. Well, what if you could eliminate a big part of that income that's taxable? And maybe that's the thing that keeps your Social Security, maybe it's only 50% taxable versus 85%. But every single penny is a big difference here when it comes to how much you could save. Withdrawals from your IRAs. Look, what if you're kind of teetering at this higher level of income, and that $30,000 that you don't need pushes your Medicare premiums to the next level, right? Kind of what we talked about when you're looking at things like Roth conversions. There's a lot of things to pay attention here. So, Uncle Sam's your partner here. They're going to get their money one way or the other. And here's the thing. If you do not do your RMD, maybe because you forget, no one told you had to, if you do not do a required minimum distribution, not only are you going to have to do two the following year, but you are going to get hit with a 25% tax penalty on the money you're supposed to pull out. And still got to pay tax on the money you're supposed to pull out. That is a huge penalty for not paying attention to this. And a lot of people don't even know these things are coming. Maybe you've heard of it before, but you didn't really put two and two together. This is the biggest silent killer of people's retirement. So a lot of the times when we do these workshops like this, and at the very end, a lot of the questions that we get is, how do I go about understanding what my RMD options are? Should I do Roth conversions? If that's something that's of interest to you or a question you have, make sure you write that down. Write us a book. Like I said, write as much detail as possible about what you need help with, and we can make sure we do that. So, tax mistake number 8, taxes on pensions, not withholding a tax on your pension. And I gotta say, obviously, it is a state-by-state piece here. I'm talking about federal taxes as well, okay? But your pension or your annuity from the government is a fully taxable income. Exclusion of that is military disability. But even military pensions are taxable, okay? Just the disability ones are not. So you have your pension from the government that is taxed at ordinary income tax. Now, remember what I just said about all the other pieces that tie into this. While you are receiving your pension, the amount of money you take on a distribution from your TSP could affect how much that tax is. The amount of money that you get from Social Security could also affect that. The required minimum distribution could also have a role on how much your pension becomes taxable. So all these moving parts, they all have to work in harmony with each other, because taking too much from one could affect the entire outcome of your entire tax portfolio, okay? So make sure you understand that how all these pieces have to move together to work in harmony with each other. Okay. Now, number 9. This is an important one. So in 2020, there was this thing called the Secure Act, and the Secure Act changed the way that we pass assets to our family. And what it did was it took away these things called a stretch IRA, okay? And the stretch IRA allowed us to basically inherit money or pass on our money, and the people that inherited it, they had a lifetime to be able to pay down the tax on that. Well, that went away. And so here's what happens. Anybody other than a spouse, I'll get to spouse in a minute, but anybody other than a spouse now has 10 years to draw down all the money that they inherit from traditional IRAs and Roth, but realistically the one that impacts the most is going to be the traditional IRAs. Why? Because for those of you that have done a great job saving, those traditional IRAs that you have in traditional TSPs, when you die, your family is going to inherit the tax liabilities that's there. So if you pass on $500,000, that's all traditional, your family is going to be responsible for the tax on that $500,000. They used to have the lifetime to stretch that tax out. Now they only have 10 years. So planning is important. Passing Roth IRAs and Roth TSPs to a family member is also tax-free like it would be for you. Now, if you're married, your spouse is going to be able to do basically spousal continuance. They're going to be able to basically take over your IRAs as if it was theirs and pay the tax on them like it was if they were theirs. So not as stringent, but for all of you that have kids that are going to be inheriting this money, it's very important that you understand how that stretch IRA rule affects your child's taxes. Because think about this, if your child is in their prime working life and they're making $100,000 a year, and now all of a sudden they have to take $50,000 to $100,000 a year for over a 10-year period, that's going to bump them to the next tax bracket. So it could have an adverse effect on your family the way that money is getting passed down. Okay. And last but not least, tax mistake number 10. I think by now you can see why this one could have actually affected a lot of people, is assuming you will pay less in taxes in retirement than you are right now. Let me give you the myth, and then I'll back it up with some numbers. Most people think that it's not a big deal for me to defer my money to my taxes to a later time because I will be making less money in retirement. Therefore, my tax bracket will be lower, and I'll pay less in taxes. And the answer to that is maybe. It depends. So let's think about this for a second. 64% of our federal employees that we have for clients, all across all 50 states, 64% of them are in the same tax bracket when they retire than they are while they're working. Why? Number one, most of you have three sources of income: pension, Social Security, IRA distributions, TSP distribution, right? You have three sources of income. In the private world, sometimes this actually does reign true, is, yeah, I'll be in a lower tax bracket. Why? Because most people do not have a pension. They're going to live on Social Security and whatever 401k distributions they take. So there are times. But because federal employees have a pension that's going to run anywhere from a couple $1,000 to $80,000, right? That automatically starts putting you into some of those higher tax brackets. And because there's so much room between each tax bracket today, makes it a little bit harder to get in and out of each of those brackets. So don't assume that you will be paying less in retirement. So one of the things that we do is you've got to make sure you get a tax analysis done. It's so important. Whether you get it done with us or somebody, just make sure you get a tax analysis done that tells you, all right, this is what my pension is going to be, right? We talked about those fixed incomes. This is what my pension is going to be. This is what my Social Security is going to be. This is what my TSP distribution is going to be. Where do I fall? And what do I have opportunities for? That's the foundational piece you have to work off of. Because when you start building out an overall financial plan and tax plan, they got to fit into these different buckets. And I'm going to challenge you a little bit to think about things a little bit differently. So one thing that I would want you to think about is most of you are in the accumulation phase of your life, meaning you're working and you're accumulating money in your TSP and IRAs and all your different retirement accounts. But when you retire, you enter into the distribution phase of your life. And that's a totally different world, totally different set of rules, different things you got to pay attention to, all things we just talked about today. But what I want you to think about is starting to assign a purpose to your money. Now, I'm not talking about a balanced portfolio. Those days, you've done the hard work, right? You accumulated money. But now, giving every dollar of your retirement money a purpose. So let me give you an example of what I mean. Let's say that we're trying to figure out this tax thing. I want to know what my fixed income is going to be from my TSP. Well, the first thing you got to figure out is how much of an income gap do I have? Let's say you need $6,000 a month to live in retirement, and your FERS annuity and your Social Security, maybe that equals $4,500. We still have a $1,500 a month income gap. So when you start looking at this, you say, out of my 500 grand that I have with TSP, how much of it do I need to basically put over into my income bucket? Just kind of set it aside and say, I'm not going to take any risk with this. This is my income. This is the money that I'm going to use. I'm going to assign the purpose of this 200 grand, right, for the purpose of income. And I'm going to draw that down, and hopefully it doesn't run out, right? There's different ways to do that, but just think about that for a second. Now you have this middle bucket. You've got this 300 grand left out of the 500 in my example. Well, that's when you begin to start thinking about, out of this money that I have left, how much am I going to do conversions with? How do I make it the most tax efficient humanly possible, right? Because then all of that leads into your long-term saving strategy. How much of it do I want to put in the market and be growth? That's where you start worrying about all those other pieces. But before we get to that long-term growth, we got to assign a purpose for all of our dollars to be as efficient as humanly possible in retirement, so that we have a healthy retirement. We're in the lowest tax bracket possible, and we're passing money along in the most tax efficient way, right? So again, it's a different way of thinking about things, but I want you to think about, have you assigned a purpose for every dollar that you have? Most of you probably say, no, I haven't, right? If I ask you, what is your overall distribution strategy for your TSP? A lot of you probably don't have one yet, and that's okay, depending on your age. But these are things to start to think about, because the way we take money from our TSP and 401ks directly affects everything we talked about today. So assign a purpose for it, so you know exactly what it's going to take to accomplish your retirement goals at the end of it. Okay. So one of the things that we do for every federal employee that comes through these is we make sure that we get you a report, and the report goes over all things that I talked about today. It tells you what your pension is going to be down to the penny, so you know what that fixed income is going to be. It tells you what your Social Security is going to be and how much that's going to be taxable, so you can start to see how that's going to formulate. Now you've got those two pieces kind of laid out, you know what to expect. Lastly, it's going to give a projection on your TSP, so you know if you keep saving at the rate you're saving, what's my TSP going to look like, and then what are the options for distribution. It also is going to tell you, based on how much you have in that TSP, well, how much is my required minimum distributions going to be, and how could that affect me? So the report that we run ties in everything. And if you want this, feel free just to put on the form that's going to pop up. Say yes, please, run the report for me. We'll just take the numbers, we'll run it, we'll send you the report. There's no cost obligation. It's what we do for federal employees all over the country. Okay. So I want to give you a couple of resources before we wrap up. If you have questions or comments, you can email it anytime at info@myfeduniversity.com. More than happy to help out in any way and answer any questions that you have. Or you could call 919-706-1846, and we're more than happy to answer any questions. And once again, at the end of this shortly, there's going to be a survey that pops up. Put as much information as you can so that we know how to help you. I don't want to waste any time. I don't want you to waste any of your time either. Let's get your questions answered, and we'll be able to help guide you along. With that, I want to say thank everybody so much for being on here. We'll talk to you all soon. Take care.